Hello, everyone. Thank you for coming. Thank you. Please, when you come on, just stay. We just want everybody to benefit from our section today. So when you come on, just stay on and invite a friend because our special guest is an expert in his field, and I want each and everyone to benefit. You know how we do it. We all can't benefit this section alone. We need to invite. Please send the invite. Tell somebody out there to come and also listen. Steve is all ready for us. So let's all share. Let's share. God bless you. Okay. Share for us, please. Okay. Without much ado, I just want to first of all say a little bit about my special guest. Some of the things he hasn't, heard from me, but sometimes things are, hold on to the right opportunity. When you get the right opportunity, then you say them. So my guest is someone that I've known over the years, and I'm so proud that today he's here with us, even though it wasn't easy. This is not something that he's new, he has been doing. This is new to him. This TikTok business is new to him. But so someone would tell me, Steve, how did you get to know Steve? So how I got to know Steve is through our first property. Like anybody else who is in search of property, you just get yourself to so many mortgage advisors. Your friends will be introduced you to so many people. So my husband and I came to this property that we loved, and they were like, to get the expert to do this for you, we want to recommend this gentleman for you. It's up to you. You can use him or use your own, mortgage advisor that you brought. And luckily, we were like, okay, because they told us the qualities that he has. And this is one of the big, builders. If I'm to mention their names, you will get to know that they are really good. They are really, really good. And that is we here. We are now trying to, get a property. And they recommended Steve to us. So we got in contact to him, and he was so good. He was so honest, and he took us through the whole process with the interest rate. Steve was, on call with us. He liked diagrams, giving you, the facts for you to make your decisions. And when you tell him that he needs to guide you, he will guide you through. So step by step, he was, feeding our brain with what is there for us to know, because we are first-time buyers and there were so many options. So the option that we were on was help to buy. And with the help to buy, we had 5%. But Steve was like, if you have more money there, you can put more. Okay. And as I grew up through that journey, I've come to understand and appreciate the decision that he made us take. And anytime we are in worry through this journey, we always call on him, and he's always there, to support us. He's an expert in his game. Someone who has been in industry for almost 30 years. 30 years will be in October the 4th, and I'm so proud of him. He is the director, and the principal of Menham Mortgage, services. And this is somebody that I really look up to because of his honesty and how he always want to put himself in your shoes to make sure that he get the right deal for you. So when Diana's Diary came into play just last month, I reached out to him and I said, Steve, this is something that I'm doing. Just look at, my motive, my ideology, my reason of supporting people. And if you're happy for it, kindly let me know. He thought of it. I sent him, the website and everything. I knew it wasn't going to be easy because this is not something that he really do. But when he looked at it, he just sent me the picture and said, Diana, I'm more than happy to come and help you with this vision. So without much ado, family, I want to introduce to you the principal director of Menham Mortgage Services, Steve Menham. Please, thank you so much. I'm so proud of you, and I don't take this opportunity for granted. Thank you so much for honoring my invitation and coming to bless us with your knowledge.
Wow. Well, thank you for the introduction. That's very humbling. It's always nice to hear that I've had an impact in people's lives, because exactly everything you've just said there is what I strive to achieve for my clients. And it's one of those where when I'm talking to people, it's kind of bringing them into my family. And I treat everybody as I would a family member. Because it's like you say, it's trying to give people the education to be able to make the right decisions for them. Because everybody has a different opinion, a different view, they have a different requirement from life. So it's really important that I hear good feedback like that. So yeah, really, really proud. Thank you.
Thank you so much. Thank you. So before you go on your topic that we have, I want you to, first of all, just give a brief of your growing up, because people out here are people that look to see better of themselves in the future that are not there yet. So I will plead with you, if you can, tell us a bit about your journey, some of the things that you were able to hold on to get you to this principle. It's a big deal.
Yeah.
It's done for 30 years. You might have, be able to go through those challenges in life and see to the goal and see yourself this way. So just maybe 5 minutes or so, just tell us a bit about yourself and your achievement and how you were able to, get to the top.
Yeah. So originally I'm from South London. So I was born and grew up in Croydon. And school was one of those things I was just never interested in. So believe it or not, where I've achieved and where I've got to was not where I ever expected I would be. Growing up, I always wanted to join the army. That was always my aspirations. And never got there. I was given an opportunity at the age of 18 when I joined Lloyds Bank. I was given an opportunity that was too good to say no. And it's not something, unfortunately, that's available widely in the financial services industry anymore. It's something that's kind of been lost to time. But it was being able to join a big organisation, and they would take you through almost like an apprenticeship scheme. So I worked for Lloyds Bank for 7 years, and as soon as I started, I had an absolutely amazing manager, and I think he was probably the fan to my spark. He was what kind of ignited that fire for financial services in me. And being young and brash as I was when you're young, you're all full of bravado. But he was very humbling. He kept me on the straight and narrow and gave me a lot of guidance. So he was probably the best manager I've had in the 30 years of working in financial services, because he was the one that set me on the path and gave me the belief that I could actually achieve something. I did not very well at school. I didn't enjoy school. There was very little that interested me. So when I joined Lloyds Bank, it was one of those where actually I was interested. It sparked my imagination. It challenged my brain in a way that school never did. So I left school, went to college. I did okay. I mean, I did international marketing, business and finance qualifications at college. But as I said, my only kind of objective at the time was to go into the army. I wanted to be a helicopter pilot in the army. That was what I wanted to do. But then joined Lloyds Bank and was able to effectively go on all of the training courses. So I would say to anybody, if you're ever given an opportunity, grab it with both hands. And that's what I did. I was able to look at the training courses that were available, take the guidance from somebody that had been in the industry as long as I've been in there now. And this is kind of where I'm kind of playing it now with the people that work with me, that trying to get them to engage in their own learning, and deal with parts and learn on things that you're interested in, that spark your imagination, that make you ask more questions. And that's what I love about this job. It's about being as nosy as you possibly can about the world and the people in it. Yeah. And that's what I love about this job, because there's no two situations are the same. And from the outside, it's really straightforward. You kind of buy a house and you get a mortgage, and it's really straightforward. But the nuances and the fine detail that go into it, I've never met two people with an identical situation. And I've dealt with, we deal as a business at the moment with over 300 new clients every year. Yeah. So we deal with a lot of people on a year-by-year basis. So I probably have had more than 10,000 clients that I've helped in my career. And it's been great because I've dealt with so many different and interesting people from all over the world. Because I started at Lloyds Bank. So by the age of 21, just before my 21st birthday, I was fully qualified. So I took advantage of all of the training that Lloyds Bank could actually offer me at that stage.
Wow.
And did all of the training, got fully qualified. And one of my main motivators to get qualified was used to get a company car. And they used to give you a brand new company car. And that was at the age of 21. I was like, wow, that's real incentive for me. So that was really good. But I qualified about 6 months before my 21st birthday. And you had to be 21 to qualify for the company car. So although I was fully qualified, I had this 6-month period where I still couldn't have my company car. So it was a lot of train journeys and a lot of taxis to get around and driving my own car and things like that. But since I hit 21, it was great, got my own car, and it was lovely. But Lloyds Bank was a great learning experience, and it really did set me up. And then what happened was I moved on to different companies. I got that bug for wanting to kind of grow and improve. So joined a company in the Medway Towns. They were setting up a new estate agency with a financial services element to it. So helped them set that whole branch up from actually finding the premises and just being involved in that. I'd never done that before, but it was just kind of more of a practical getting involved and asking questions. So again, my whole life is mostly around just asking questions. And it's one of those things that I think people are very scared of asking questions because it makes them feel insecure. It's like they don't know information. But in my world, asking questions is so important. I think it's really key for people to ask questions because it builds on that foundation of knowledge. And I think that part is really important. You have to ask questions. And I always say to my clients, there's no bad question. Even if you're asking me the same question 10 times, it just means I haven't explained the answer correctly to you. So always ask me questions, and that's how I work. But then what happened was I moved from there and moved into more specialising in new build houses. And that's where I got involved. I worked with the armed forces, so I got my dream to come true that I kind of was working with them, but not for them. I never joined the forces, but I worked with them. So I was able to help a lot of the armed forces buy their first houses. And that was really rewarding to kind of educate them because they were taught how to be soldiers. They weren't told what happens after they're a soldier and how to deal with life. So that was really rewarding being able to do that. But also from a very selfish point of view, I got to travel all over Germany, got to travel to Cyprus, so did some really good traveling as a result of it. So that side of it was absolutely brilliant. And probably the best part of all of that was I met my wife, and that's the best part. So she was a mortgage advisor at the time, and she was working for a different department of the same company, and that's how we met. So so that was probably the best part of all of that, really. Yeah.
Thank you so much. Thank you so much. What I've learned from all this is that any opportunity that we get, we have to, grab it and just use it. So this is an opportunity that we've gotten, and I know each and everyone here are going to, grab it and just use it to stand on to build up something. God bless you. Thank you so much, Steve. So now, without much ado, I'll let you dive into the topic.
Absolutely. So I think what I wanted to do is kind of give people a bit of a context in what's happening in the world at the moment. A lot of the questions we get asked is why are things in the market happening, and why are the interest rates?
I know you will love it when you are giving, you are good at the data. So
yes,
today is not going to be the last. We will arrange a Zoom when people get to know you. Then you can do your drawings and pictures so that people understand it.
Absolutely. But I think that the whole market and the global market's important to understand as well, because we have regular meetings with all the different lenders, and we get the reports from their economists in terms of what's happening and the commentary that's going on in the world. And I think even if you just look over the last 6 months, quite a lot has happened in that period of time. So within the last year, obviously, we had the Labour government came out and had the autumn budget. Trump came in, and we've seen all the kind of turmoil that's happened as a result of that. But for good or bad, what has happened is that inflation has increased. And what has happened is that borrowing has increased by about 1%. And effectively what that means is that it's costing governments more money to provide their services. So it's costing more for them to borrow the money. And obviously it's then for the governments to provide things like the welfare system. And the governments have limited amounts of ways of raising money. So if they're having to pay out for their debts, the only other way of increasing their revenue is either to reduce services or to increase taxes. And I think we've seen a bit of that in the UK, literally in the last 6 months. And I think that's had a big impact. But what's really impressive is that the UK is not as bad as everybody thinks. So when we look at comparing UK to other countries, for instance, our debt to GDP. So the GDP is how the measure of the gross domestic product of the UK and other developed countries. So if you go back to 2008. The UK used to spend about 30% of its GDP on debt, and we're now much more up towards about 95%. So it's increased a lot in that period of time. But actually, it's not as bad. At the moment, we're sitting at about 95. The US is at about 120. Japan is about 250%, and China's about 150. And obviously the governments have big expenditure to spend out on, and there's lots of reasons for it. So you've got the increasing costs of the NHS, and they've got to find this money from somewhere. But the biggest impact that's happened recently is obviously the global turmoil with Russia and the US stepping back from defence. So what we have seen as a nation, as the UK, is we haven't had to spend as much money on our defence, and that's been really good because it has meant that the government have had more money to put into the NHS and the social services. But that's now changing, and obviously everybody will be seeing the news where taxation's changing and how all these things come into play. But what used to happen is the UK government, or the UK as a country, used to be very productive, and on average it used to be about a 2% per year that the UK used to grow. But that has reduced, and productivity is about 0.3%. So the amount of money that the government have to spend is reducing, and this puts more pressure on them. And what this basically means is that things are more expensive. It means it's harder for the government to have spare money to spend on different projects. And obviously, from my perspective, I look at it in a very selfish way, is what would they have been able to do with this money if they'd invested in infrastructure like housing and that sort of thing, because obviously that's where my life is. And when you compare it to other Western European countries, if they had matched what other European countries had done, we'd have 4.3 million more homes available today. And the UK is a very, very small market. Obviously, in the spring statement in March, the government pledged that they would have 1.5 million more houses available by the end of this Parliament. So there's been a lot of difficulties in terms of building houses and the infrastructure. But what is really good is that as a result of all these pressures, the interest rates are on the way down, because what the governments don't want and the Bank of England don't want is us to end up in recession. So they release money by reducing interest rates. So at the moment, it's actually a relatively positive outlook. Supply of houses is very good at the moment. We're almost at an 8-year high. So demand for housing and mortgages is very strong at the moment. But there's a lot of challenges to make sure that happens, and that falls on the government to make sure that happens. So obviously the spring statement, they said that they were going to put £2 billion of funding towards affordable and social housing. So again, that's really good. It's going to help those people get into the property ladder and be able to start their journey. But what was a little bit disappointing was that, they weren't really doing anything to help buyers. They didn't extend the stamp duty breaks that they were giving. There are no new government schemes. So like you mentioned, Diana, we helped with the Help to Buy. There's none of that available in England at the moment. So it is a little bit more harder. So as a result of that, what's happened is that the lenders are stepping up. So the lenders themselves are becoming more innovative. So from that perspective, we're seeing that the lenders are able to support first-time buyers. The market is very much geared towards supporting first-time buyers, and we've got lots of really good innovative options from lenders, from minimum deposits. So we've got some lenders that will require 0 deposits, which is really, really good. We've got some lenders that only require very small deposits, so it might only be like £5,000. So there's a lot of really good kind of lender-led support that's coming, which is replacing what the government used to do. I suppose the only government scheme that's really available is the shared ownership, which is the part buying and part renting. That has definitely become more popular, but again, that requires funding from central government to build those houses and to have local authorities be able to build those houses and housing associations to build those houses so that people can afford to buy them. But as a market, at the moment, things are looking very positive. I mean, we're seeing the cost of borrowing for mortgage lenders actually reducing. So it's really good. I mean, I'm seeing people that a couple of years ago, when the economy was really bad and when Liz Truss had her budget and everything went very wrong and interest rates went very high, we're seeing people now that are seeing a reduction in their mortgage payments, and they're seeing life become a bit more easy. But again, year on year, we're seeing the rates come down. And again, structurally wise, the way that lenders borrow money, that cost is coming down and they're passing that on to us. And the latest report we had from one of the lenders was that this year alone, they're expecting 3 more Bank of England rate drops. Now, whether that happens or not, this time last year, we were told we would have 6. We've had nowhere near that. So economists are great at giving predictions, but they definitely don't have a crystal ball, unfortunately. But we are expecting the next meeting is on Thursday this week. So we're looking at hopefully another 0.25% drop from the Bank of England. A lot of the lenders in preparation for that have already started. We're getting lots of emails through saying we're dropping our interest rates or watch out for our rate drops. So we're seeing that. The Financial Services Authority, who regulate the market as well, they've come along and have given some guidance to lenders, which has allowed them to lend more money, to make it more affordable and people to be able to stretch their salaries further to achieve those houses. Which is good and bad, because it's stretching people's budgets and times are difficult right now. Everybody's got lots of bills and that's an expensive thing. But it's also helping people get on the property ladder because you're able to extend your salary quite a lot. So the market, yeah, it's an interesting time. I mean, the last if you just look over the last 6 years with what's happened in the world, it's the sort of thing that they're now starting to build into policy, and we're reading about it in the training manuals for new advisors coming into the industry. The ups and downs that we've seen in the last 6 years are all showing in the training manuals now. So it's quite an interesting aspect from that side of it. And the market is ever evolving. The regulator, the Financial Conduct Authority, are always looking at ways to improve it and protect the consumers. And rightly so, to make sure that the advisors are giving value for money and making sure that clients are getting the best from their advisors. And that's one of the things when we set the business up in its current format, was that we put customers first. And I think that was a really big core statement for us, having learned from lots of big corporate companies that we work for, that people are individuals. They're not just numbers on a spreadsheet. So I think from that perspective, we've had a lot of learning. So yeah, it's been an interesting time, and I think even if you look over the last, like I say, 6 months, there's been a lot going on in the world, and there are challenges, but it definitely feels from a mortgage perspective that things are getting easier. So interest rates are getting lower, affordability is becoming better. There are only small increments, but they're in the right direction. So always good reason to be positive on these things.
We're happy to know that.
Yeah, absolutely. But the other thing I wanted to touch on was what you can do as a first-time buyer. I'll start with first-time buyers, because when you're buying and selling, so if you're a next-time buyer, it becomes much more complicated because there's more moving parts to it. But if I kind of touch on a first-time buyer, because it applies to both groups of people. So yeah, in the UK, obviously, in terms of getting yourself ready to be a buyer, it's not just a case of finding the house. Actually, finding the house is probably one of the last things I would always recommend people do, because there's a lot of steps beforehand. And again, you went through this, and we did a lot of work with this. And a lot of it's about paperwork. And it's definitely the one thing that most people absolutely hate. Nobody loves doing life admin and getting everything organised. But when it comes to buying a house, whether you're thinking about doing it in the next month, in the next year, next 2 years, it's worth starting that process immediately. And the first place we normally would discuss with people is getting a copy of your credit file. So it's looking at your credit file and saying, does everything that's reported on there look correct? Are there any mistakes? And making sure that what is being reported and what will be seen by the mortgage lenders, is that correct? Because if anything is wrong on there, or is anything negative on there, then that can have a massive impact in either being able to get a mortgage, because it might be there's something on there incorrect that is going to stop you getting a mortgage. It may be that you've had problems in the past, and let's be honest, people have good times in their lives and they have difficult times. And credit files are one lender's or one view of the world. So having problems in the past isn't the be all and end all. It doesn't mean, oh, I've missed a payment, I'm never going to get a mortgage. It might be that if you've missed a payment or you've failed on an account, that yes, it's going to make it more difficult, but it doesn't make it impossible. And there are a lot of things, and this is where we give our clients advice to say, okay, these are the things that you can do. And the easy wins are making sure you're on the electoral roll. So you're on the voters roll showing on the credit file at your home address, making sure that all of your address history is correct. Because the mortgage lenders will look at 3-year history, whereas the credit file will have a 6-year history. So they'll be looking at things over a much longer period of time. So making sure you've got all your addresses on things like your bank statements and your pay slips, making sure they are correct, so that when they're presented to a lender, they all are of a similar address and at the same address. And it's things like, if you're self-employed, that can become quite difficult as well, because from an accounts point of view and from a taxation point of view, you'll want to show as minimal profit as possible. But from a lender's perspective, they're going to be using your profit. So it may be that you need to be working with your accountant to make sure that your income is showing as strongly as possible, to make sure that when it comes to applying for mortgages, you're showing that in the best possible way. So there are situations where we're having to delay applications for clients for maybe 6 months or a year whilst their accountants get their accounts affairs in order. And we're happy to liaise and talk to people's accountants to try and help and make things look as good as possible when people come to putting applications together. And there's lots of different paperwork, obviously, that's going to be needed. But obviously, we deal with lots of people from all over the world. I'm very fortunate. I've got clients from literally all over the world. I've got a lot of friends in South Africa. So I've done Zoom calls for people that are moving over to the UK who have been living and staying in South Africa and getting them ready to come across to the UK and giving that help and support. So again, we help people with all of that. And even when they're freshly here, there's lots of kind of barriers to getting a mortgage. And we help people in terms of preparing for once they've been in the UK for a little while, in terms of what they can do and how they can get themselves in the best position with visas and what the lender requirements are going to be. But with most of it, it's about just making sure you pay your bills on time, you don't miss payments. It's the little things that make the biggest impact. But from a lender's perspective, what they're really looking at is how good is your credit score and what is your history, because they're basing their decision on your history. So the better your history, the better the decision from the lender. And that again feeds into how big a deposit that you've got. So obviously without the government schemes at the moment, deposits have become much bigger impact in terms of buying houses. The biggest problem we find is people that are in rented finding it really hard to save a deposit. That's really hard. But again, the lenders have recognised that, and there's lots of schemes starting to appear. There's two really good schemes with TSB and with Skipton Building Society, where they will help people where you don't require any deposit. And that can be really good. And this is where the lenders are innovating and always looking at what can we do to help. And that's why we meet with the lenders. We meet with them on a regular basis. We probably have at least one or two a week into the office, and we talk to them and we give them our feedback and what we're hearing from different kind of clients, because we deal with lots of people from all over the UK. So although we're based here in the Midlands, I grew up in the southeast originally, but moved to the Midlands when I met my wife. She was from Worcestershire, so moved up to Worcestershire and now live in the countryside, which is very different. So not very much hustle and bustle of the city life anymore. So very much more relaxed. But yeah, in terms of getting yourself ready, I would say get financial advice. That is really the key to it. And our process, the way that we work here at Minor Mortgage Services is that we look at it initially in two ways. So we always would have a first call or telephone call or a video call with somebody, and we would do an affordability check. So it's really a case of that person getting to know us, asking all of the burning questions, because you'll talk to friends, you'll see things on the internet and you don't know whether they're 100% accurate or whether that's been misinterpreted. So we'll myth bust all of the kind of questions and queries that people have. And what we'll then do is we'll look at the affordability, we'll answer the main questions. Most people that come to me are very simple in terms of the questions, because they want to know, can I get a mortgage? How much is it going to cost me each month? And how much can I buy a house for? So most people are very, very kind of very basic in their initial requirements. And then I give them lots of homework, which is really cruel from me. But it's trying to engage people's brains to start thinking about what's important to them. And Diana, you will have been through that part of the process.
I did.
Yeah, so, and it's looking at that and challenging ideas. So somebody comes to me and says, yeah, I want to do this. And I'm like, absolutely brilliant. Totally hear what you're saying. But why? Why are you thinking that? And it's for me to understand and ask the questions to make sure that the decisions that you're making are not dangerous for you. But it's not my job to say, you must do this or you must do that. That's not for me to say. My job is to guide you, to give you the reasons for your decision. If it's dangerous for you, I would definitely be going, no, don't do that. It's a terrible idea. But at the end of the day, I might say that and you go, Steve, I hear everything that you're saying, but that's the route I want to take. And I'm like, okay, it's your life, it's your money. I can't force you to do anything. I'll definitely help you the best I possibly can, as long as you know that I think it's a terrible idea. But most people are really good with that, and they will listen to what I say. They come to me for the advice, and that's what I like to do. I like to help people with that side of it. So once we've done that affordability, people can go away with a really good sense of what they're doing and why they're doing it. And then it's more of a formal process, because we're working on, let's see the pay slips, let's see the passports, let's see the bank statements. And we then get the mortgage in principle. So lots of lenders call it different things. You get it agreement in principle, mortgage in principle, mortgage promise. So they're all basically the same document. And it's effectively the lender doing a credit score based on the information that we've got to hand to say, yes, they will give you a mortgage. Now, just because you do a mortgage in principle with one lender doesn't mean you're going to stay with that lender. It might be that another lender, when you find the right house, has got a better deal for whatever that reason might be. So it might be that you do a decision in principle with one lender and an application with a different lender. But it's a good indication that will you be able to get a mortgage, and is all the theoretical affordability work correct, and are we understanding fully what you do? But what's also really important is you have a good source of information behind you as well. So whenever you're getting financial advice, it's really important that the person you speak to gives you their Financial Conduct Authority registration details. And regardless of what you're talking about in terms of your finances, make sure that the person that's giving you that advice is qualified to give you that advice. And you can go onto the Financial Conduct Authority's website, and there'll be a register, and you can type in the 6-digit code. So every firm has a 6-digit code, and ours is 805613. And you can go onto the FCA register, and you put that in, as it tells you all of our, and they call it permissions, and it's what we're allowed to give advice on. And when you go onto our register, actually, we don't tell everybody everything that we do, because if we did, we'd be here for 2 days whilst I go through all the individual things, because we get involved in mortgages, protection, so your insurances, we get involved in pensions, investments. So although the name is Mind and Mortgage Services, we are much more of a holistic financial services company. So yeah, it's important you understand who you're talking to and that they're qualified to give you the advice. But also having a good solicitor when it comes to buying a house is going to be really important.
Yes.
Because, yeah, the solicitor can make and break the experience. Absolutely. So I think if you're buying a house and you get it an estate agent or a house builder recommend the solicitors, you're not always going to get the best experience. But sometimes it can be a cost-based decision, because those sorts of transactions can be quite costly. And by using a recommended solicitor, it can keep the cost down. So again, it's a good way of weighing up a decision. But again, a financial advisor, and us included, we have a recommended solicitors that we work with in partnership with, and they are absolutely brilliant.
Your side with the solicitors, everything went so smoothly. I didn't feel a thing. It's like everything was so, yeah. So,
absolutely, yeah. And that's what it should be. It should be that the solicitors and the financial advisor, and this is where a lot of clients need to be a bit more brave, and I try and encourage clients to be more brave, because they are in charge. You are the boss. You're the ones that tell your financial advisor and your solicitor what they should and shouldn't be doing. And a lot of times, financial advisors and solicitors forget that. They forget their place. They forget that they work for that client. And I have many conversations during the week reminding solicitors of who's in charge. And it's definitely not me, and it's definitely not the solicitor. And I'm reminding them that they need to listen to the instructions that are coming from their clients. So the solicitors we work with are absolutely brilliant. They are there and able to help us. They've dealt with many transactions for me personally, so they've been good. And every financial advisor will have their own solicitor recommendation, because they will have had a good experience. And what you don't want is somebody that's going to give you a bad experience. You want somebody that's going to be able to do the job and do it professionally, because it's a reflection of you as a company. If I'm recommending somebody else, I want that person to work to the same level and service that I would give to my clients. I don't want them to be letting anybody down. So yeah, that's a really important thing. But again, when it comes to buying a house, there are costs involved. Obviously, the deposit is the first one. The next one is obviously your legal costs and your stamp duty. Those are big expenses in amongst all of it. But a lot of people forget about the little things. So two of them could be things like surveys. When you buy a house, a mortgage lender will generally do the level one, the valuation on the property, for free. So that as a cost would be maybe £200 or £300 if you were paying for it individually. But again, depending on the age and the condition of the property, you may want a level 2 or level 3 survey. So again, that's an additional cost. The level 2 survey typically is about £700. A level 3 can typically be £800 to £1,000. And there's different reasons for doing those levels of surveys, and that would be individual to each house and each individual person. But again, it's an extra cost that you're not necessarily expecting whilst you're going through that process. But again, once you get into the house, you've then got a lot of costs that you weren't really expecting. So one of those could be things like you've got to buy furniture, you've got to put the carpets in, you've got to buy the kitchen utensils, you've got to buy the sofa. So again, buying a house is not just those initial setup costs. There's an immediate cost for setting up the home, and that can be really expensive, and a lot of people can get caught out by that. So again, that's part of what we do. We prepare people for that, and we say, okay, so what have you got? What's in place at the moment? Kind of where are you with your finances? And again, we're not here to judge. It might be that somebody's got very little in the way of deposit, and we need to be really careful. It might be you're very blessed, and it might be you've got a very big deposit, because again, that might be a really good situation whereby you're able to decide where you spend your money, how much you put for the deposit, how much you put for new furnishings or renovations on a house. It might be like a lot of our first-time buyers, you're trying to buy the best house with the minimal amount of money that you've got, and money only goes so far. So it can be a real challenge. And again, that's where a good financial advisor will be able to help you through that process, because they'll be able to say, okay, well, the advantage of putting down a slightly smaller deposit means that your payments are going to be a bit higher, but it gives you that emergency fund, or it gives you the money to not take out a sofa finance or a loan for doing the garden or whatever it might be. It gives you the ability to do those things. And those things apply to first-time buyers. But when you come to being a next-time buyer, you've got another whole level of complication on the back of that, which is even more difficult. Because you've got to then pick the right estate agent. Who's going to sell your house? And again, with estate agents, they can be good and they can be bad. So again, it's making sure that they are going to sell the house for the best price that they can get for that house. And it's important that people listen to it, because people always value their houses more than they might be worth. It's just human nature that people think they've got a beautiful house and it's worth more money than it's actually worth. But an estate agent will be very clinical about making a decision on that in terms of, okay, where does it sit in the local market? So listening to what they say is important. Because what you don't want is your house just sat on the market, not selling, because it's demotivating and it can be quite upsetting if that happens. But then if you're buying your next house, you've got the decision on what do you do about the mortgage, because the chances are you've already got a mortgage. And there's lots of options. If you've got an existing mortgage, you can transfer it to your next property. It's called porting. So you can transfer it, and there's some pros and cons to doing that. Or do you just go with a brand new lender, but there might be fees to come away from the old lender? So again, speaking to a financial advisor, you can weigh up the calculations and see which is going to be the best option for you. And again, it's working out what are those costs going to be. With next-time buyers and first-time buyers, one of the things we do is we go through a moving costs affordability check for people. So not only are we checking how much money they can borrow, but how much is it going to cost them to buy the house? How much are the solicitors and stamp duty and moving costs going to be? So we do that with that. But then you've got the coordination of timelines. And this is probably the most difficult part of buying and selling houses, is you might have 2 or 3 people in a chain, and it's trying to understand, okay, where are we in terms of everybody agreeing on one day to get moved in, and that could be quite challenging. Solicitors will want to target a particular day. For whatever reason, solicitors love doing house moves on a Friday. Whereas if you're trying to pay for removal costs, doing it middle of the week when it's quieter will be cheaper. So if you're paying a removals firm, try and get a house move done in the middle of the week, because if you're paying for a removals firm, it will be cheaper.
Okay, thank you.
So there's a little tip. Absolutely. So yes, there's lots of challenges, and there's no two situations are the same, and I think that's important from an understanding perspective, that there are no two people that are the same, two situations are the same. It's everybody is completely individual and have their own motivations, and it's making sure your advisor listens to that. That's really the important part as well. And that's what me and the team here do. So me and my wife, we work together, which is a very exciting experience, because Monday to Friday I pretend like I'm the boss. I'm not really, because wives, they're always in charge. And then we've got Jamie, who's an advisor with us as well. So again, getting into the industry, the two people that work with us, Emma and Jamie, when we recruited, they came from very different backgrounds. Jamie was a teacher, and Emma was a care home manager. So she used to work in an old people's home. We used to be a care home manager. For individual reasons, they wanted to come out of those careers, and we knew them as friends as well. So it was good for them. We were able to help them. But it was interesting that taking them on and using their skills that they learned in other careers to bring forward. So Jamie was teaching children up to the age of about 7 or 8. So he was great in front of controlling people and trying to, I would not want to do that job for any money. So I salute every teacher out there in the world, because it's a crazy job.
Yeah.
But the skills that he learned about time management and presenting and teaching is very similar to a financial advisor. Because again, we're advising, we're teaching people how to make the right financial decisions for them and their family.
Yeah.
And Emma was exactly the same. She was a care home manager, so she came from that compassion of looking after people and having people's best interests at heart. So she came from a very caring background. So they both came with very different skills, but were very adaptable to the job that they now do today. And Emma's job is slightly different. She's a paraplanner. So again, if you were looking to get into the industry, a paraplanner is effectively a qualified advisor, but doesn't actually deal face-to-face with clients. Emma does a lot of the technical work behind the scenes for us. So she can read my mind. It's scary, because I will start a sentence and she go, "Yep, done it, Steve. Already thought about it. It's already done." She's a dangerous human being, because she can read my mind. But it's great. So she's able to do that and use her skills in a way that she will see things in a different way that I see things. I'm old. I've been doing this job now for 30 years. I'm nearly 50 years old, and Emma's just turned 30. So again, different generation to me, and they see things in a different way. And Jamie's exactly the same. He was 30 on Monday last week. So it's great to have kind of younger minds around us as well, because they challenge the way I think about things. Because that's always the danger, is that you end up doing a job and you become stagnant, and you don't look at new ventures and new kind of ways of giving advice. And Emma and Jamie do keep me honest with that, and that's a really positive thing.
Yeah.
But I feel like I've done a lot of talking there, Diana. I don't know. Is that?
Yes, we've got some questions for you.
Oh yeah, definitely.
I've got a lady called Ekia. She wants to ask you, what's your advice on newly built or older mortgage buildings? Which one is the best?
Oh, now there's the $1 million question, isn't it? What's best? Best is really hard to describe. I suppose generically, new properties, if you're buying a brand new property, I would always say it's never going to be 100% perfect. It's a hand-built product. Anything that is hand-built has the potential to go wrong. So buying a new house can come with its own individual problems. but you know that you've got the support and the backup of a major house builder, that if there is anything that's wrong, that they will come and put that right for you. So you don't have very much upkeep. It's a much easier house. And I did exactly the same thing 20 years ago. I'd always bought older houses because I love character houses. So personally, my favourite houses are Georgian houses. I just love that period. It's kind of the house that looks like when you were a child, you drew that little square house with the chimney and the front gate. That was just kind of growing up was my perfect house. But I now live in a modern house. Well, it's 20 years old now, but I bought a modern house. And for the first 5 years, I literally did nothing. I changed light bulbs. That was about all I did. Didn't have to do any work. But older houses, typically, it comes with more maintenance. There's more upkeep. But you've got the character. You've got the kind of history of a house as well. And in the UK, in the old days, the house deeds, so the ownership documents used to come on really big bits of paper. They used to be like gold leaf and embossed, and they were beautiful works of art. And if you ever get to see one of those, they're absolutely beautiful. So old houses are great from that perspective. You generally, older houses will be bigger as well. They tend to have a lot more space. So again, it depends. If you are good with DIY, you kind of have a passion for restorations maybe, and you're prepared to do work for a house, older houses are great. If you just want a house that's nice and easy and maintenance free, then yeah, in theory, you're going to be looking at potentially going for slightly newer houses.
Yeah, thank you. My question to you is that, like, if you want to consider, like, you are investing and you've got a house that is maybe £150,000 at the time that you were trying to buy that house, financially you were not all that okay, so you were able to raise your deposit, okay, just to acquire the house, and it's just a rental property.
Okay.
So my question to you is, first of all, if you are able to get the house and you got a fixed interest rate, you know, you can get a variable rate and all that, like the one that we did the first time, 5 years plan.
Yeah.
Now, monetary wise, you've been able to save, and you want to cover the whole amount because the interest rate that was on the house is high. Let's say every year you are paying almost 4,000 on that amount of mortgage that you had. Okay, so this time around, after 3 years, the agreement, which is the 5 years, is not up yet, but you want to pay off the whole amount because you think that it's a bit of saving, you getting that money. So my first question is it a wise decision to pay off all that mortgage? That maybe the principal is left with £106,000.
Yeah.
You are in your third year of the agreement and you want to pay off all that money. Is it a wise decision to pay off all that money? And the second question is that how would you get, I don't know. You answer the first one and I'll come to the second one.
Okay. So yeah, paying off the mortgage. So again, it depends what the reason for paying the extra money off is. Again, I would normally advise to do the calculations. Have your financial advisor look at the overall calculations, because paying off more than 10% of the mortgage balance will typically come with penalty payments. So what you need to do
is
make
sure. Question I wanted to ask.
Yeah.
You pay off the interest that is left. Okay, so you've even answered it. That was going to be my second, question to you. That if you are going to pay the whole principal amount, that interest rate, are you going to escape, the 2 years interest rate of 4,000 every year, or they will just add it to it?
So if you're paying it off, the penalty payment will be payable to the lender, but it's a mathematical question. You'd have to look at what the interest rate is you're paying, what the saving would be, and verse that against the early redemption penalty. So it would be an individual calculation. You'd have to work that out as to which way would be best to do that. It could be a case that you use your overpayment facility and then make a larger payment at that stage, or you wait till your current deal's finished, because you can normally make overpayments per year. So again, you can use the overpayment facilities over a couple of years, reducing the mortgage down. And when you do that, you can either leave the mortgage payment the same and reduce the number of years on the mortgage, which is the most efficient way of doing that, or you can reduce the mortgage payment and keep the number of years the same, which again makes the monthly payment better for you.
Okay, so it's not advisable paying it all off if you've got that savings lying down in your account.
Well, it may be, it may not be. Again, it depends what the interest rate is. If your mortgages, make the maths easy, 4%, and your savings is only 1%, then paying off the mortgage sounds like the best option. But it depends what the fees and penalties for paying off that mortgage would be, and would it be better to do that or not? So again, you could work out the maths, and you could do that calculation. Again, we do that all the time for people to see what is the best way of dealing with that for people.
Yeah. Second house. Yay!
Hello, I'm back. I think it said I was talking too much, Diana.
No, you are not. They need to bring all their questions. Okay, they've got lots of questions here for you.
Okay, fire away.
Yes, thank you so much. I was just telling them that, a lot of mortgage advisors are, monetary, you need to pay this, you need to pay that. And we were shocked the first time you told us that, no, you don't have to pay me. It's the company that has to pay me. And ever since, you are so genuine, you are so real. So I recommend you to, anybody that is, getting on this mortgage ladder. Steve is the best person, guys. It's not because I know him personally, it's because he has helped me. He has helped me a lot in this mortgage industry, and I'm more than happy to recommend him to all of you here. So the other question is from our lady. Okay, we've answered lady Ekia. The other one is, having a student loan, can it hinder you having a mortgage if you're having a little
bit. Having a student loan is taken into account by the mortgage lenders, so they do take that into account. But it doesn't have a very big impact. It very much depends on how big a student loan it is, but if it's your normal sort of student loan, it doesn't have a massive impact on affordability. Lenders aren't really that you're not penalised very much by having a student loan. Obviously, there is some impact. So certain things that impact how much lenders will lend to you is based on your salary bandings. So depending on how big your salary is, they will lend you more if you earn more. So typically, if you're earning maybe over 50 to 75,000, they'll lend you a lot more in terms of affordability. Having children, they may take into account child benefit and government benefits, but they will make an adaptation for childcare costs and obviously having children, because they are expensive. I've got a daughter and I know how expensive she's been. So
thank you.
So
yeah, my other question to you from our panel, from Clifford, my brother, he's saying that are older houses more likely to appreciate in value than a new built home?
Oh, again, that's going to be down to individual area. Typically, older houses have the ability to appreciate more. Older houses, depending on what work you do. So you could buy a house that's had no work done to it for maybe 30 or 40 years. You'll be buying that at a cheaper cost because you're going to need to invest money into the property in terms of decorating and maybe bringing central heating and electrics up to date. So it potentially, if you buy the right house, it has the ability to increase in value better. And again, it depends. So there's lots of areas. You tend to find that one area will become very popular, but then house prices become prohibitive in that particular area. So people then move to the next town or the next area just outside. And then you find that it kind of expands and expands and expands. And London's a great example of that, where you might find one part, it gets very expensive and people then start moving a very small amount down the road or something like that. So it might only be half a mile down the road or something like that. But it then can increase the value. So you could, again, it can be a little bit of a gamble because you don't have any 100% guarantee what's going to happen. But if you look at what's happening in a particular area and then look at where the expansion is moving to, you could then potentially buy a house. So typically somewhere like Northampton versus slightly further down the motorway towards London, maybe Watford, for example, it might only be a half-hour drive on the motorway from Northampton to Watford. Watford house prices will be much more expensive compared to Northampton, further out from London, but Northampton has seen in the last 10 years, has seen a really big rise in house values because Watford has become prohibitive for people. So you then look for the next place. So again, that can work in lots of different areas all over the UK.
Okay, thank you very much. And when you are choosing a house or buying a house, is it better to take a detached house, semi-detached, terrace? What will be your advice?
Again, it can be really difficult. You could buy £1 million house that is a semi-detached house. You could buy a detached house that might be 100,000. So again, it would be more about what you're looking for. Obviously, there's pros and cons. Obviously, a detached house is likely to have more garden, more space around it, whereas a terrace house, potentially, if you've got neighbours, so you're going to have to get on well with your neighbours. There's no choice about that. So you've got to be a good neighbour and you've got to have good neighbours. So that can be a big factor. So I would say there's no good or bad house. Everybody has a different preference and a different kind of view on it. Yeah.
Thank you very much. You are considering remortgaging. You want to remortgage your house. What are the things to look out for when you want to remortgage?
So again, it depends what the reason for the remortgage is. So if you're just literally moving from one lender to another, or your mortgage deal's coming to an end, it's making sure you're aware of the market. So again, we do this for all of our existing clients. We will compare their current lender versus the rest of the market. So I had a client on last week, which we did this exact conversation, and I've helped her for many years. And the last time she moved to a different part of the country, and as a result of that, she had a solicitor and had an absolutely terrible experience with the solicitor that she chose. Unfortunately, she didn't go with our recommended. So her mortgage deal's come up for a review, and we're reviewing that at the moment and doing that. One of the options was moving to a new lender, and that would save her £10 per month on her mortgage by moving to a new lender, which in the grand scheme of things is not a lot of money, but it's £10 a month. I mean, it's money in your pocket rather than giving it away to a bank or building society. So I'd always say have it in your pocket. So, but for her experience of a bad solicitor last time, she said actually the time commitment and the fear of a bad solicitor was something she was not prepared to do. So I think it's important you look at all of the factors of what your current lender can offer you and what the costs would be to move to another lender. Because it may be that your current lender has a closing down fee, And that can vary from lender to lender. So you need to know all of the calculations and components. And again, your advisor will be able to do that to say, okay, by moving to a new lender, it's going to save you, I don't know, £200, but over a 5-year period. And it depends how valuable that £200 is. It's an individual decision. I've moved people because they've saved £1 a month. And I've had people that have saved £50 a month, but they don't want to move to a new lender. They like the lender they're with. They've got their internet banking with them. They have their salary paid into the same bank, so they have it all on one app. And people like that. So again, it's an individual decision.
Thank you very much. With regards to the rate in mortgages, what percentage? Because I think the last 5 years it was around 0 point something. I think when we were going one, you were like, no, I don't want us to do this. But now it's even like 4 point something. And what is the best rate as a, someone going to buy a house? What is the best rate you can advise in today's market?
So in today's market, again, it's all down to deposit. So it depends how big your deposit is. But if you had a very big deposit, so maybe 40% of the value of the property, something like 35-40% of the value of the property, you'd be looking at interest rates at maybe 3.9 something percent, so under 4%. And those have been reducing. There's more lenders that have come with those rates. But again, if you go to the other end of the scale and you were looking at maybe only putting down a 5% deposit, you'd be looking at something around the 5% mark. So again, it depends on how big a deposit. It can be quite a big difference. But one of the things to look at as well is lenders price their products in two ways. So what they'll do is they'll give you a lower interest rate, but may charge you a setting up fee. And that setting up fee can be anything up to maybe £1,000, maybe more. Or what they then do is the other way around. They say, right, we're going to charge you a slightly higher interest rate, but charge you a smaller setting up fee or no setting up fee. And again, it's making sure your advisor looks at the best option for you. And the way we do it is, as guided by the Financial Conduct Authority, is to look at the cost over the mortgage deal. So if you're looking at a 2-year, how much is it going to cost you over 2 years to have that mortgage? But typically, if your mortgage is under 230,000, paying a setting up fee generally doesn't make sense. It's normally better to not have that setting up fee. But again, it's an individual conversation for everybody, because some people say to me, Steve, what's really important is we get the smallest mortgage payment. We've got a bit of spare cash now. We're prepared to pay the fee up front to get that smaller mortgage payment. And some people are open to the option depending on what's best for them.
Yeah. Thank you so much. So in terms of rate, what would you advise? Variable or fixed rate?
Again, that is a conversation with each individual person. There are pros and cons. There is no perfect mortgage, unfortunately. The perfect mortgage is the one you pay off, so that you don't owe the bank any money. And this is what I always joke with my clients is I'm trying to make myself redundant. That's what I'm trying to do, because it'd be great if nobody had to borrow money. That would be the best thing. And my granddad, rest his soul, was a wise man. And one of the things he told me was, there's 2 rules of borrowing money. First one is don't borrow money because it costs you lots and it's expensive. But if you do borrow it, pay it off as quickly as possible. Yeah. So from that perspective, that's a good rule to live by, definitely.
That's very good. That's very good. The reason why I ask is that, you are able to look into the market and predict. Because back over those years when we approached you were like, you guys have to do it fixed. And that was the best thing you did for us, because you gave us the options to choose. That's why I'm asking, like with the variable and the fixed rate. So we have to look at the market with your mortgage advisor to support you in making the best decision.
Absolutely, and it's a conversation because it's individual to everybody, and there's lots of pros and lots of cons to each option. There is no perfect option. The fixed rates are great; they give you stability, they give you security. But the variable rates are great, especially in the market we're in at the moment, where rates are coming down. You could take advantage of it. It means the starting point might be higher, but it might be over a period of time. Now, again, whether that pays out or not is yet to be seen. But there are some advantages to taking those variable rates as interest rates start to fall. And there'll be a point where it's sometimes personal preference for the individual. Is security more important, or is it a case of monetary cost? Is it the finance part of it?
Yeah. Thank you so much. I just want to ask for a friend. She was trying to get a house, but because they are saying that his paperwork, bank statement, everything was not adding up. So she had to go through a broker.
Mm-hmm.
The broker offered her a very high rate, which was like about 5%. Okay. And I was like, no, I don't think you need to go for this. I might refer her to you. And she was like, no, I'm desperate. I need to get a house. I'm this years old and all that, but the understanding, and I'm so glad that you are here to explain for all of us to understand. It's not a matter of just getting the house at the right interest and affordability and at your own comfort. So that way, maybe someone might be here that is going through the same situation, that a broker has promised him or her that, oh, it doesn't matter, I'll get you the house because your finances are not adding up, these are not adding up. Is this something that you advise for such a person to go for?
Absolutely. And this I would say, never jump at making a rash decision with a mortgage. You are committed for such a lot of money for such a long time. You need to make sure that decision is the right decision. And your financial advisor should be guiding you. They shouldn't be just pushing you to make a quick decision. It should be a considered decision. And that's really important. And if it is a paperwork issue, it's looking at that paperwork and saying, okay, what is the issue we're having with that paperwork? What is it that is causing a barrier with the lenders? And are there things that we can do to overcome that? And again, there's lots of different things that we can do as advisors that will help that scenario. And again, lots of things that the lenders don't like to see. So it might be they're presenting a bank statement, there's lots of gambling or something like that on a bank statement. Lenders are really not keen with it, but it doesn't mean that that's a showstopper. So it might be we just use a lender that doesn't want to see any bank statements. So again, there are lenders out there that don't want to see bank statements. They're more interested in other documents. So again, it's talking with your advisor and having an advisor that understands the requirements of the different lenders.
Thank you so much. I don't want to take much of your time. You have a lot of questions here. I'll let you just, I think
keep them coming. I don't mind.
All right. Thank you so much, Steve. What is shared ownership and what is it? An ideal thing at all? Is it an ideal thing at all to do shared ownership from our fire lady?
Yeah, okay. So shared ownership is, the easiest way of describing it is you part buy a property and then rent the bit that you don't buy. So it's the only kind of government-backed scheme at the moment. What it allows you to do typically is buy a bigger house than your salary would normally allow for. There's definitely a lot more paperwork. It's much more complex because you're dealing with not only the calculations from the mortgage lender, but you're dealing with the calculations from the shared ownership side of things.
Yeah.
And sometimes they conflict. So it might be a lender says, yes, you can lend and borrow this amount of money, but the shared ownership is a different figure. So it's making sure that those two things align to give you the best outcome. But typically you're part buying, part renting, and you have the option to do what's called staircasing, which is buying extra shares in the future. So typically you could buy 50% of the property, and then maybe in a few years' time you buy another 10% or whatever it might be. So again, yeah, it's a really popular scheme. It comes with more complications because you're paying rent as well as paying a mortgage. So it is definitely takes a lot more consideration if you're buying a shared ownership, but it's a great way of getting on the property ladder because you can typically buy a bigger house than you would be able to afford without the shared ownership if you were using just salary. So it's a good scheme. It's not for everybody, but it's one that's worth considering, and we're seeing a lot more of it now that the government schemes don't exist. So things like Help to Buy, they don't exist anymore. So shared ownership is definitely becoming more popular.
Thank you very much. I think you answered that. Someone said a flat flavored moon. She asked a question: flat or a house? Which one is better to buy? And you said it's own preference, isn't it?
Yeah, it is preference. I suppose with a flat, you've got less property maintenance costs because you'll be paying into a management company and they will be taking care of the actual building and the facilities and communal areas. So again, it can be less maintenance. It could be it's more affordable because flats tend to be cheaper, so it's a greater way to access the property market. But houses, again, you're going to get more space potentially. Don't get me wrong, there's some absolutely stunning flats out there that would be bigger than most houses, but typically you're going to get more space. You'll have your own garden and space like that. So again, it's going to be preference. I see people go from flats to houses and from houses to flats, and they all have their individual reasons. But typically it's down to the maintenance and the upkeep. People buy flats for the ease of home ownership, really.
Thank you very much. There's a lady called Ipia, my girl. She's asking, what are the pros and cons of refinancing a rented property?
Pros and cons. So I suppose the downside is you've got less profit from the property by refinancing it. If you, it depends what the interest rate is, and if you're borrowing extra money in terms of the refinance, you're potentially borrowing higher, so your interest costs are going to be higher. But I guess if you're financing against a rental property, in theory, you're financing against a business. So the risks to you personally tend to be detached, so that people feel less emotionally attached to a rental property. So from that perspective, it can be less emotional in terms of the finance. So yeah, the pros and cons. So yeah, I mean the downside is you're potentially eating into your profit because you're more of the rent's going towards the financing costs if you're raising extra money, that is.
Okay. Thank you very much. I've got Ash D. He wants to ask you, can you explain to us why it's important to know your debt to overcome ratio? Like debt to overcome
do you mean debt to income ratio?
Yes.
Debt to income ratio. Okay, yeah.
Yeah, debt to income ratio. Yes.
Yeah. It's a really hot topic with lenders at the moment. I mean, that's a good question. So what lenders are looking at, and this is really important when you start getting into your credit file before you even start looking at houses, is looking at how much of your income is spent on debt. The lower that ratio, the better. Once you start getting over about 35% of your income on your debts, the lenders will start restricting what they will lend to you. And that can be things like your credit cards, it can be your car finances is normally the one. You buy a nice brand new Mercedes and it's £600 a month, that can be a big hit on your income. So again, that can have a really big impact on it. So what you want to do is keep that low. But some other little tricks and tips on that is if you're using credit cards, the best thing to do is pay more than the minimum balance or the whole balance off every single month. The best use of a credit card is just don't use it. That's the best way of having a credit card, just don't use it. But if you are using it and you've bought some items on it, is keeping the balance that you're using to less than 50% of the available credit. So if you've got a facility of £1,000 on your credit card, don't go over £500. Staying below that. If you go over that, again, that can look negative towards a lender. So the lenders will take that in a negative way. Not always, it's one of the factors. So lenders do lots of different kind of profiling checks on people. So it's not a be all and end all, but it's another thing that can help improve your situation if you're on that borderline between an accept or a refusal from a mortgage lender. So yeah, debt to income's a big thing. trying to keep that down, you can mitigate that in many different ways.
Thank you so much. Thank
No
you.
worries.
That was a difficult question, but you smashed it. Thank you. So he's on here. He says what, so they can know what they can actually afford versus what they were told they can afford.
Yeah, that sounds like a common thing that I do come across, because that's why we do our initial conversations in two parts. We do the affordability, and the way I joke about it is, you could tell me all your information. You could say your name's Minnie Mouse and you're a NASA space pilot and you earn £1 million a year, and I can do all my affordability calculations based on that. But when we actually get the documents, if it says that you're not a NASA space pilot and you're not earning £1 million, that will have a different outcome. So when your financial advisor does the decision in principle, from our perspective, we will do a decision in principle based on seeing documents, because the more accurate the information that goes in, the more accurate the outcome will be. So it's about making sure that the data that goes in is 100% accurate. So if somebody says, oh yeah, I'm on about 30 grand a year, and you put in 30 grand, it could be they're on 26 grand plus some overtime plus a bonus. Now it might be that the bonus isn't very regular and the lender doesn't take the bonus into account. So that will reduce the amount that the lender would lend. So again, it's really important to break down what the affordability is, to make sure that you get the right outcome at the decision in principle. But the decision in principle will look at your credit file. So again, it happens from time to time. People forget that they've got a credit card or a finance on a sofa or something like that. So we'll do the decision in principle. It will come back with a reduced figure. We'll then go, right, we need to see the credit file. What have we missed? And then they'll go, oh yeah, I remember I got the laptop on finance or whatever it is, and that will have an impact on affordability. So there could be a number of reasons why you're getting a different outcome. It's usually a conflict from what's being put in and what's actually correct.
Thank you very much. So you bought a house in an area, let's say London, and you want to buy a second house in the same place. Is it allowed?
In theory, yes. It depends what you're doing with that second house, would then dictate what you can and can't do with that house. So if you're buying it as a second home could be for holidays, or it could be for a dependent. So it could be you buy a house for your children to live in or something like that, if you've got adult children. If you're going to buy a second home to be rented out, it has to be on a buy-to-let mortgage. If you then, let's say, take a second house and you say, oh no, it's just for my children to stay in, but you then rent it, you're actually in breach of your mortgage contract, and it's a form of mortgage fraud. So you've got to be really careful with that when you're explaining exactly why you're buying that property and the use of that property. And your advisor will then be able to tell you which is the best option, whether you go down the buy-to-let route or a second property route. But yeah, absolutely, buying two houses in the same street is absolutely fine. We do that a lot for people. They have parents that they want to live next door because it's easier to care for them, and they take on that responsibility of the second mortgage. If your income can afford it, then absolutely, yeah, no problem with that at all.
Okay, thank you very much. There's a lady called Wellmark. She says, please, how long should I have to be in UK before I'll be qualified for a mortgage?
Before you qualify for a mortgage, again, most lenders, it's a minimum of 12 months. So as long as you've been in the UK for 12 months, but then different lenders have different requirements. There's lots of different kind of rules around that. Some lenders say you've got to have lived in the UK for 12 months, 3 years, 5 years. If you're putting down more than a 25% deposit, they will overlook some of the rules. So having a bigger deposit helps. So again, it depends what sort of visa you've got, because different visas may come into play. But typically, as long as you've been in the UK for more than 12 months, there are lenders that would look to help on that basis.
Really?
Yeah, it's good. It's there. The lenders are aware that we're a multicultural society now, and it really does help. It's not like it used to be in the dark ages. The lenders are very innovative and trying to help people. So there are some instances where they can't help, but the majority of people, as long as you're working and earning and you can evidence that, and your intention is to remain in the UK, then absolutely there are lenders that are prepared to help.
Oh, I'm glad to hear that.
It's good.
Yeah. All right. I'll take this last question, please. In case I skip your question, it's not intentional. Okay. There's a lot of questions, but I'm pleading that I will get Steve to come on again, and just come and help us with all these questions. My last question is from Clifford. It is a beneficial to have a certain expenses as rent, credit card payments from a lender's perspective.
Okay, so having a credit card will, in the long term, if it's maintained well, so when I say maintained well, is you're using 50% of the credit facility, you're clearing the whole balance every month, and doing things like that, then yes, in the long term, that will help and will benefit. If you're doing that because you're going to be buying a house within the next 3 months, I would say don't even start. You need that credit card history for at least maybe a year for it to have a positive impact. Initially, if you just took a credit card, it will knock points off of your credit score, so it has a bit of a negative impact to start with before it starts building back up. So it depends when you're looking at buying a house. So I get different people. So if I say to somebody, yeah, we're looking at buying within the next 3 months, I would say don't bother starting with a new credit card. Just don't do it. There's no point. You won't be able to make enough of a gain within that three months. But if they're looking at maybe 18 months time, I'd say, okay, make a start and put like your weekly shopping on it and then pay it off every month or every week that you get paid. Just make sure you don't go over that 50% credit limit and get the whole bill paid off, and that will help build up over time.
Wow, that's excellent. Thank you so much, Steve.
No worries.
I appreciate your time. I really appreciate your time, being expert in whatever you've told us. And I know a lot of people are going to contact you. If you don't mind, it might go on the net, so I wouldn't let you put your number, but your email and your work number in case anybody wants to watch this and contact you later. Are you happy to share it here, please? Yeah,
absolutely. Yeah.
So you can go ahead and give us your email.
So my email, the best email is info@minum-ms.com. But if you just Google Minum Mortgage Services, you can see that on there. That's the spelling, Minum. It's an Irish name originally. That's where it comes from. So you can always Google us. Our website's got all of our details on there. We've got our pictures on there. And there's some useful guides on there as well. So if you are a first-time buyer, you're just looking for there, you can go onto our website, and we've got under our guides, there's lots of little downloadable features. So you can definitely have a look through that. And we cover lots of different aspects on there as well. So from first-time buyers for insurances, all kinds of different things on there. So yeah, lots of helpful tips and guides on there as well.
Yeah. So family, I'm more than confident to recommend Minum Company to all of you, because I personally have been helped by them, and a lot of builders, when you go to them, they will recommend Minum mortgage services to you, because they have been in the industry for almost 30 years. And I'm proud to say that this October the 4th, isn't it?
Yes, absolutely.
We're going to celebrate their 30 years in, this kind of mortgage business. So they are expert, they know what they are doing. And to get somebody to come from their decks, the principal himself, to come and speak to us. It's a great opportunity. And Steve, we don't take it for granted. Thank you so much for honoring my invitation. And I know that a lot of people are going to reach out to you, because nowadays you don't know what you are getting yourself into. a lot of mortgage advisors are just into for their money, and they just show you anything. So if you're a first time buyer, just contact me and I'll link you to Steve, and he and his team will be more than happy to help you. I really appreciate this time that you have given me.
You are more than welcome, and thank you for having me on. And if I can be of any use to anybody, or you want me to jump on another podcast like this, happy to get involved. I just love educating, so maybe next time we just do loads of questions and answers.
Yeah, and next time we will do the Zoom, so that I know you are expert in drawings and giving us what is really going on. And
absolutely.
Next time, I'm so pleased that you are more than happy to come again on Diana's Diary to be a blessing.
But thank you for having me today, and thank you for all the questions and for everybody to listen to me.
Thank you. So family, thank you all for coming.